Thank you very much. So we have lessons from 50 billion in exits, how to create value, how to create a business worth more with Thomas Smale, Smale, close enough, or pretty close, I should say, not close enough. I was just asking him what their commission structure is, because FE International is an investment banker, so kind of interesting, super interesting subject. Why don't you come up, Thomas? I don't want to eat into your time. All right.
Hey everyone. So today I'm going to be talking about lessons from over $50 billion in exits. So as just mentioned, we're a investment bank which focuses on the sale of technology-based businesses. We do a lot in the SaaS industry. So the things I'm going to be talking about today primarily are things you can do in your business to make it worth more in the long run. Whether you're building $1 billion business or a $10 million business, all of the data points are applicable, and everything I'll be talking about you can apply in your business today and think about to figure out when you do decide to sell or exit your business, what it might be worth and what's most important to acquirers. So if there's one thing true for everyone in this room, is that one day you will have to exit your business. You might not necessarily be thinking about selling your business tomorrow or in 5 years. Maybe you're not even thinking about selling at all, but at some stage, you do have to leave your business. Our job as an investment bank is to maximize the valuation you get when you either decide to sell or need to sell. So some people may think they're never going to sell their business, and they think, I'm going to keep running the business forever. But often when people do decide it's time to move on, that's because there's been a change in personal circumstances or something has changed in their business. Something has forced them to decide they need to sell now. So regardless of what stage you're at in your business, even if you're not thinking about selling today, it's still important to have an understanding of what drives ultimate valuation. So for some context, before I get into some more specific data points and lessons, a lot of the business, so a company name is FE International. A big part of that is we work on international transactions. We work with a lot of clients in Paris, London, lots of different European cities and European locations who are selling to acquirers based in the US. So if you look in the US alone, right now, and this is just through the end of 2022, there's nearly $4 trillion in dry powder with private equity firms. And in simple terms, if you don't know what dry powder is, it's capital available to deploy. And the nature of private equity is if they do not deploy that capital, invest that capital, it has to get returned back to investors. So there's a lot of negative press saying kind of SaaS valuations are down, people aren't acquiring SaaS businesses at the moment, but the reality is that's not really true, particularly if you have a business worth, say, below $250 million or 250 million euro, that's not really that relevant. And you can see from the graph, there's been a pretty significant increase over the last 10 years. The industry was relatively flat, relatively slow, until we got to about 2012. Since then, there's been a significant increase in private equity capital, and that means ultimately more funds out there to do deals and buy businesses like yours. It doesn't matter if you're based in France or wherever you might be based in the world. If you're building a technology-based business or a SaaS company or whatever it might be, there is an acquirer out there who will want to buy your business. I spoke a bit about a lot of negative press and doom and gloom, people saying deals aren't happening. Where you tend to get that from is the big publications. So if you read something like TechCrunch or Bloomberg, they're reporting on billion-dollar IPOs or multi-billion-dollar transactions. The reality is if you have a relatively small business, so again, say below 250 million valuation, those deals are still happening. So just as a relatively simple data point, if you look at Wall Street, so Wall Street generically would be US larger deals. Between 2021 and 2022, there was a 38% decrease in total valuation sold. FE International, on the other hand, we saw a 51% increase. And we primarily specialize in deals up to $250 million in valuation. So you can see that there's still a lot of demand for technology-based businesses, even if Wall Street and the Main Street press are reporting that that's not the case. So now I'm going to go into some specific data points. We've sold over 1,200 businesses. We track data points from every single one of them, and we use that to establish very accurately what businesses are worth when we're speaking to founders, speaking to investors, and establishing what they might be able to sell for. So all the data points I've got, you can take away as things to focus on in your own business if you want to help it be worth more. Whether you're an employee, whether you're CEO, founder, whatever your position is in the business, almost every single person can have some influence over these metrics. So number one is, and I can see the format's messed up a little bit, the higher your net dollar retention, the higher your valuation will be. So in simple terms, businesses with strong net revenue retention are worth more than businesses without high net dollar retention. So here on the graph, we've got companies that are 100% and above, which generally speaking, if you're 100% or above, that's a really good metric and a really good level to be at. And companies below that level will sell for less. This is primarily, for reference, this is primarily B2B SaaS companies. So if you don't have a B2B SaaS company, we often see net dollar retention that might be 60 or 70% in smaller businesses, which can be fine, but it's just something to keep aware of, that this is relative to your business model. The next metric we see, which is a very important driver of valuation, is your revenue growth. Businesses, in very simple terms, businesses that are growing faster will sell for more money than those businesses that are not growing. And there's a pretty significant increase in average multiple as you grow at a faster level. So if you look at businesses growing below 20% year on year, and this is top line revenue, they'll generally be selling in a 2 to 6 times revenue multiple range on average. Businesses growing over 40% are selling up to 14 times. So you're almost getting double the valuation if you grow above 40%, and your valuation is significantly lower if you're growing below 20%. And the reason that's important from a timing perspective, when you're thinking about selling a business, is a lot of people only think about selling when their business has started to slow down or it's not growing anymore. And if you wait that long, then you can be in a position where your business starts growing at a slower rate and your multiple is significantly lower. If you sell while your business is growing, then the multiple you're going to get for your business is significantly higher. So it's important to take that into account. A lot of people think if they sell while they're growing over 40%, it's too early. But the reality is that can be the best time to get a deal. And there's very strong correlation from the data that we've looked at with growth rate and ultimately what your business will sell for. Following on from this, it's also important that growth is consistent. 1 year of growth is great, but if you can grow consistently, so in this case, this data shows your 2-year revenue growth, there's also a pretty significant increase in multiple. So if you look at businesses which have grown over 40% for 2 years in a row, the multiple gets even higher. So on the higher end, up to 16 times. So 1 year of growth is fantastic. 2 years of consistent growth is even better, particularly if that keeps going. And then again, you see at the lower end of the market, if you're not growing as much and your 2-year growth rate is slower, then your business is ultimately going to sell for less. So growth is important, but consistent growth is even more important. So in the context of building a business to sell, that means that running short-term promotions, whether that's like discounted annual plans or anything like that, is not necessarily the best way to increase your valuation. You need to do things that will consistently help grow your business. And one of those might be focusing on net dollar retention, which we already saw is an important metric when it comes to valuation as well. When it comes to building a business, it's also important that you're profitable and efficient with your spend. If you are spending $100 in marketing or 100 euros to generate $100 in lifetime revenue, or $100 or 100 euro in lifetime revenue, that business is not worth as much as a company that's spending more effectively. So what this shows is your sales efficiency. So in really simple terms, how efficient your marketing spend is turning into revenue. A business with higher sales efficiency, so your marketing spend is more ROI positive than a business that's not, is worth, again, significantly more. So you can see a business that has sales efficiency below 20%, the average multiple is in just below 5x on an annual basis. If your efficiency is over 40%, the average multiples go above 10 times. So it's important that you're growing on an annual basis. It's important you're growing consistently, but it's also important that your marketing spend is efficient. You can't just spend a lot in an inefficient way to drive growth. You have to be efficient with that growth, and it has to be cost effective on an ongoing basis, not just one-off. Every single person in this room is ultimately in the right room. We specialize in the technology sector, so we don't just sell SaaS companies. We also sell digital media businesses. So that might be agencies, it might be blogs, it might be podcasts, anything which relies primarily on content to generate its revenue, newsletters, businesses like that. We also do a lot in the e-commerce space, so that might be Amazon FBA stores, that might be businesses selling physical products on Shopify, and we also sell SaaS companies. What we can see from this is that SaaS companies sell for significantly higher multiples. So one thing is what you can do to increase the value of your business, and the other thing is making sure you're building the right business in the first place. So if you're at B2B Rocks or other similar events, you're in the right room because basically everyone here is in the SaaS space, so you're building a business. Just because of the fact it's in the SaaS industry, it's worth almost 3 times more on average with an equivalent e-commerce business or an equivalent digital media business. So growth is important, but your business model is equally as important. So for everyone in this room, you're already in the right room, and that's definitely important. Or if you think about launching a business, that's important too. So if you're kind of currently in that idea phase, now's the time to think about launching a SaaS business rather than a media business. If you're in the SaaS space and if you're active on LinkedIn, Twitter, Facebook, whatever it might be, you've probably heard of the rule of 40. I think it's generically used on a consistent basis by people to say rule of 40 is an important metric. So what we've looked at here is it actually true? Does rule of 40 actually matter? And I guess in simple terms, rule of 40 is your revenue growth rate plus your EBITDA margin. If that's in excess of 40 or 40%, then you're meeting the rule of 40. So you can see here the bar and then the darker area on the right. So companies on the right are meeting or in excess of the rule of 40. You can see those companies on average sell for more than businesses which are not meeting the rule of 40. So it's something that everyone talks about, but does it really matter as a metric? Our data says that it does. So that does not mean, and from what you can see from this data as well, you do not necessarily have to meet the rule of 40 to have a sellable business. Every single person in this room building a company can sell it. The ultimate question and the ultimate lesson from this talk is, what can you do to make more from your business? So what this shows is that businesses that are growing and they're EBITDA positive are ultimately worth more than businesses that are not, or businesses that are growing at a slower rate and are less profitable. So it's an important metric to focus on. Companies that are either meeting or exceeding the rule of 40 are selling ultimately for more than businesses that are not. But if you're not hitting that level, you can still ultimately sell your company. You can see actually the highest multiple on here was around 35%. So it doesn't technically meet the rule of 40, but it's very close. So it's all very well talking about theory. All I've really done here is amalgamated a lot of data from numerous transactions to kind of show you what makes businesses worth more. Ultimately, the vast majority of businesses will not check all of these points. You're not going to be growing 40% over the last 2 years. You're not necessarily going to hit the rule of 40. Ultimately, when it comes to selling, you can still sell your business. You'll just get more for a business that's growing at a faster rate. So I'm just going to go very briefly into a deal we've worked on just to give you an idea of what the market is seeing for a real business that we sold recently. I can't disclose the name, but I can give you all of the other information about it. So in this case, the business was growing at 43% year on year. And we spoke earlier about 40% being an important level. So it was just above that. It had 110% net dollar retention. It had 8 figures of ARR. And interestingly, it had 17% customer churn, which is actually quite high if you consider the net dollar retention is 110% and really strong. So in the case of their business, they had a primarily consumer-facing SaaS product when they launched, which had relatively high churn, but they pivoted their business when they learned about the metrics that made their business worth more to focus on things that would ultimately grow net dollar retention, so focusing on bigger accounts rather than the smaller accounts. So they were churning smaller customers, but focusing on the bigger customers who would spend more over time and churn at a lower rate. So you have to look at all of these metrics together. If you independently looked at the 17% customer churn, you would say that's very high. But if that's translating to strong net dollar retention because you're losing the smaller customers and focusing on bigger enterprises that hang around longer and spend more, then that can be a great thing for your business. Just to give you an idea of like what a business like this looks like behind the scenes, these companies, particularly that we represent below 250 million in valuation, don't necessarily have venture funding. They might have raised a seed round or a Series A, but they haven't necessarily always raised a huge amount. In this case, it was just a solo founder. There was no business partner. It was just one person running the business by himself. They were profitable, and I mentioned why profitability is important. It's definitely important when it comes to valuation. It doesn't mean you can't sell if you're not profitable, but profitable businesses ultimately will sell for more, particularly in the current market, even though there's $4 trillion of dry powder. Buyers are looking for profitable businesses more than ever. So they're profitable, even though they had a team of 75. They were run entirely remotely. And this business sold relatively recently. We're seeing more and more companies now move back into an office, but it ultimately doesn't really matter if you're running remotely or in an office. There's acquirers for everything. They were focused on product-led growth. So their marketing spend was very efficient because they were growing with a product-led approach. And that worked for them from day one. And it worked for them as they grew into the higher cohorts of enterprise. They were very efficient with their marketing spend. And the founder in this case had grown the business as big as he could possibly grow it himself. And he wanted to sell to someone who could take the business to the next level, which is the most common reason why people exit. It's not health problems, it's not money, it's not anything else. It's always that they've reached the maximum level they can get the business to themselves and decided that now's the time to move on. particularly if we consider that, back to one of the earlier slides, that if you're growing 40% year on year, and in this case it was 43%, your business is worth more. If he continued for 2 more years and the growth rate dropped to, say, 18%, as we saw, the multiple might have been half of where it was. So this is a very, very common reason. Deal at high level, we received 11 competing offers for the deal, which is very good. Generally, anything over 5 is a good outcome. The deal was 90% cash up front. If you work with a good M&A advisor or a good investment bank, you don't have to accept 10%, 20% upfront, which we hear quite often. 10% of the deal was paid after 12 months based on reps and warranties, which is basically contractual compliance, nothing misrepresented. There was a very short transition period. The owner was out within 3 months. You don't necessarily have to stay in the business forever. You can transition quickly. And the buyer was a US-based private equity firm. And ultimately, the end result for this business was they sold for $75 million. And with that, over 10%, so over 90%, over 60 million of that was in cash. So pretty much out of time now. So if you just take away 5 things from the presentation, work on improving churn, or net revenue retention specifically, keep your business growing, focus on the rule of 40. There's always dry powder, so someone's always out there looking to buy your business, and get an understanding of what your business is worth. So if you want a free valuation, feel free to scan the QR code. Our team's happy to put that together for you. We also have a booth out in the main area, so feel free to come speak to me or one of my team. And thank you very much. If you have questions, I'm happy to hang around at the end. Thank you.
Thank you, Thomas. I think this, some of the issues Thomas brought up, there's a guy I follow on LinkedIn called the SaaS CFO, Ben Murray, and all he talks about is these different numbers and these different ways of evaluating your business and how to get your numbers right. So this is really important. He said the reason most people leave is because they want to improve their business, but you don't want to have legacy reporting. So it's a good idea to put in these different numbers, these different KPI metrics early on so that you know what's going on with your business and you're making sure you're focusing on the right things and creating the right kind of values in case you ever decide you do want to exit. Hold on. So up next at 10:30, we're going to have how to build AI products that are more than just wrappers. And that's with Aaron Goldsmith. So there's going to be quite a few talks today on AI. Which is kind of a really important subject, but hopefully you'll hang around for that as well.